Well, good afternoon, everyone, and I guess good morning to my Hawaii listeners for this web show. Welcome back to another episode of the Mortgage Law Today show, um, sponsored by Polunsky Beitel Green. This week we've got, or this month, actually, we only do this monthly, but this month we've got some great attorneys and actually a very good friend of mine, uh, Jeff Naimon from Orrick, along with his partner Caroline Stapleton. I'm excited to have a conversation with them about all the different kinds of things going on in the mortgage legal world. Normally, we would be joined by Loretta Salzano. Loretta is, I think, probably right about now looking at the Aurora Borealis somewhere in Norway. Hopefully, she's not eating the licorice, which is awful. Um, I also am usually joined by a member of Polunsky Beitel and Green, that being Marty Green this week. But I think with all the money that they're spending on this sponsorship, they can't afford good internet at this point. I don't know. Marty may join us momentarily. Hopefully, he will. So I'm gonna go ahead and jump right in and ask our guests to introduce themselves. I could sort of introduce Jeff because I know him well, but I don't know Caroline that well. But I will before I sort of pass the baton. I'm going to say that one of my favorite Gilligan's Island episodes is when Thurston Howell III sees this. It's basically a guy in a gorilla suit, but he's going around the island, and Thurston Howell goes, "Egads, a Yale man." So with that, I'm going to give it to Jeff, who I know is our resident Yale man today.
Wow. Um, I guess I was a Yale man a long time ago. Um, because I think I'm the same age as you are, Brian. Um, so
You
I'm
remember
Jeff
that
Nation.
episode?
I do, of course I do. And I think it's Thurston Howell the fourth,
Oh, you could
actually.
be right.
But I don't know. Um, the I'm Jeff Naiman. I'm a partner in the DC office of Orrick in our so-called fintech and financial advisory group. But that what that really means is that we represent financial services companies and people interested in buying financial services companies or selling them or investing in them or doing business with them or them themselves in a pretty wide variety of, regulatory enforcement, transactional kinds of matters. So we do um, lots of different things for people. And I guess, as noted, I'm old, so I've done a lot of different things over the course of time. Um, I am, honored to be here with my partner Caroline, who I work with on so many different, and varied things. And although she's but a youth, um, as you can all see, but she's just been she's such a great partner to me, particularly in enforcement work, where she's kind of like the Oracle of Delphi, understanding what the regulators are thinking about. So. So we work together and we try to help clients through whatever the issues of the day are, using our knowledge of how, these businesses that you guys are running operate and the web of laws and contracts in which we're operating, and hopefully being able to engage the regulators around the facts so we can get to fair results for our clients.
Great.
Um,
Thanks, Caroline.
yeah, I'm happy to introduce myself. Although, Jeff, if you could just always introduce me as the Oracle of Delphi in all circumstances, that would be excellent. I really like that. So I am Caroline Stapleton, also a partner at Orrick. Jeff and I have been working together since 2013 in mortgage and other financial products and services, representing financial institutions of all sizes and varieties, from banks to non-banks, to service providers and technologists who are thinking about how to basically bring financial services well into the 21st century with AI, algorithmic tools, and alternative data. One piece of my practice that I'm particularly interested in these days is how financial institutions, including mortgage companies, are going to be incorporating AI into their consumer-facing interactions. So that's definitely something that is on the minds of not just folks who work at Orrick, like Jeff and me, but of our lawmakers at the federal and the state level, So that's been kind of a recent area of exploration and thought leadership for us at Orrick. Looking forward to talking about all of the issues that are on the agenda for today, and it's great to meet everybody.
Great. Thank you very much. Appreciate a great intro and good topics probably for us to launch into, hopefully in the future on this web show. But I do want to start today with something Orrick worked on. I know Jeff worked on personally. I don't know if Caroline worked on it as well. But a couple years ago, we had the CFPB funding case at the Supreme Court. A lot of interesting issues there. And the Mortgage Bankers Association filed an amicus brief with the court that was drafted, I think, in large part by Orrick. And so, Jeff, I'd like to give you a chance to talk a little bit about that. And maybe you can sort of, sorry, I'm in an airport, but that you're hearing that background noise. And by the way, we are going to have another guest who is the guy cleaning the empty boarding area that's right behind me. Uh, anyway, so I'd like you to talk a little bit about the amicus brief, maybe some of the arguments in there, and then we'll go into a little more generalities around the role of the judiciary now in moving policy in the current environment.
Yeah, no, and I have to say, like as a lawyer, I mean, I'm not sure if it's how exciting it's been, especially the last couple of years in the mortgage business, and the mortgage origination business. But as a lawyer, it's been one of the most exciting times ever to be here because there's been, such enormous changes in kind of law and how the courts are looking at things. So, in the case that we filed the amicus brief, and we filed one in the kind of the prior case, seal of law, and then there was, kind of the payday lender challenge to the payday lender rule that went up to the Supreme Court on the basis of the CFPB's funding mechanism. And in both of those matters, the housing trades, and it wasn't just MBA, it was MBA together with the National Association of Home Builders and the National Association of Realtors. So that's a number of pretty weighty trades. All took kind of a joint position from the housing market trades that was actually neutral on the real issue involved in the case. The real issue involved in the case that we filed the recent amicus brief on while at Orrick was whether the CFPB's funding mechanism was permissible or not. And in the prior case, the seal of law case, it was about whether the structure of the CFPB was permissible. And most of the banking trades took a variety of positions, mostly that no, the CFPB shouldn't be funded, and previously that the structure was illegal, and in hopes at some level that the Supreme Court would do away with the agency, which was a very interesting kind of like, well, what happens? Has a federal agency ever got? I mean, the Interstate Commerce Commission lasted at least 30 or 40 years after they lost all authority. So that 30 years later, there was still an Interstate Commerce Commission, which is kind of an interesting. It's hard to make federal agencies just go away. But in any event, our position was neutral on the real issue in front of the court. And the positioning was that we just wanted to make sure they didn't get rid of all the post-Dodd-Frank rulemakings around which the industry had collectively spent billions of dollars to comply with. So we moved from the good faith and the truth in lending into the TRID world. And maybe much more importantly, even although that may have been the most difficult of the transitions, with respect to ability to repay and qualified mortgages. Without the CFPB reg, there would be no qualified mortgage exemption from the ability to repay, kind of broader rule. So the whole mortgage market really relies on that because without any further regulation, the statute, the regulations just evaporated overnight, in essence, it would have created chaos. And so we basically wrote, amicus briefs to the Supreme Court from, in the affected industry saying, hey, whatever you do, whatever you do on the main issue, don't leave us in a chaotic, legal situation that will generate, a generation of litigation. I mean, I know our firm is still heavily involved in crisis era loan litigation, right? So loans that were made in 2004 are still being litigated over 20 years later, right? In these RMBS and related cases. I can only imagine what would have happened if the Supreme Court had said, yeah, your funding is illegal and everything you've done for the last 12 years is gone, right? That would have been just disastrous for the industry. I think it would have stopped mortgage lending in its tracks. And
Yeah, I
that's what we
think
were trying to stop.
well, and I think I wrote one of my mortgage musings at the time saying that the Fifth Circuit had sort of unleashed all the wild monkeys on on the population here, let the cages open and running wild, without some kind of, what are the rules? I mean, do those rules apply? Don't those rules apply? So I think that the amicus brief was well positioned for the industry to say, okay, we can't just have this kind of craziness. We need to have some structure. We need to live with the rules that we've got and not have them be in some sort of uncertain state. And I think, you got that result at least. Although, there were some people who said, well, we still want to get rid of the CFPB. We just want to keep the rules. But you guys didn't really take a position on that issue, or not you guys, but the industry. The industries did not really take a position on that, which I think was probably right.
No, but it was kind of interesting how the MBA kind of positioned itself. And I know it's something that lawyers who were at the CFPB have said our seal of law brief was their they were always citing the MBA amicus brief because they thought it was really helpful to them in other contexts. And so on the one hand, like even in the most, in the immediate past, CFPB director Chopra, who did not have a famously warm relationship with any industry that he regulated, was, I know behind the scenes, I think really very appreciative that MBA hadn't taken hey, you got to throw away this whole CFPB concept. And so I think it actually kind of positioned MBA in a positive way, with the agency, just to not take the position that they should be flushed, right? But it was an interesting position. It's a positioning issue for every trade association of how they can best represent, kind of be an advocate for their members. And
Well,
I think they kind of did it. They got it
I
right.
I think you're being kind to Director Chopra, who famously referred to people that do the kind of work that we do as leeches who only want to pad their billable hours. That doesn't seem like he was very appreciative of your brief in making that comment. So, all right. Well, let's sort of move on to the broader question of sort of the role of the judiciary and these amicus briefs may become even more important going forward, given that the Chevron deference has been I guess eliminated now. That a Loper-Bright standard, which sort of throws back to the courts to the sort of the power to interpret agency uh, interpretations and statutes and regulations, and seems that that's where the power should rest if you're talking about an Article 2 judge. But what are your thoughts on where some of that stuff is headed for policy making versus trying to get things done in Congress, which can be very difficult, if not impossible?
It has been difficult, although the trigger leads got enacted.
Yeah,
It
well,
took
that
me
only took
until
3 years and stops and starts and hanging by a cliff, cliff edge. But
on
yes, they got it done. It was incredible that they got it
they
done, and
got it
that's
done,
why
and
they're
we were like
high-fiving each
amazed,
other.
by the only piece of bipartisan legislation. So, um, no, it's very interesting to me because I mean, kind of, and I have to also say it's the greatest time to be an administrative law lawyer ever. To kind of be in Washington, being an administrative lawyer when all this stuff is occurring. For many years under the Chevron case that you mentioned, Brian, basically the agency won, right? The agency took, almost any position at all, and the courts would say, oh, we just got to defer to the agency because they're kind of the experts. Um, but at the same time, there was a long term, in my view, and I'm interested if Caroline has a different view, because Caroline spent the beginning of her legal career at the OCC, which regulates national banks and federal savings banks. Um, but my sense, particularly when I was a young lawyer, was that the agencies and the agency lawyers were incredibly conservative about what authority they did and didn't have, and would be really reticent to put forward a rule that they didn't have strong authority. It was not like well within their authority to issue. And they did the work, and they did careful work on what a rule would have in it. And they did they made sure that they were within their authority. And no, they didn't lose a lot of cases, but maybe they shouldn't have lost a lot of cases, right? Um, and my sense, and this is, in essence, a bipartisan sense, or, is, the agencies became either, I don't know if more politicized may be the right word, or at a minimum, more likely to be willing to take risk that a rule that they really want, that their administration really wanted to push through, even if it might be challenged, that even if it might lose a challenge, they're willing to take some risk on those things, where in the past, I think they were less willing to. Caroline, do you have a view on that at all?
Yeah, well, I think that what maybe folks don't understand who haven't worked in a federal agency is that it's not just Chevron that's a source of deference to agency decision making and expertise. There's also the Administrative Procedures Act, which actually codifies the arbitrary and capricious standard for agency action. And yes, that's a narrower term than kind of agency interpretations, but that's still a place where at least in my experience working in the government, agencies were very focused on making sure that final agency actions were defined, that everyone knew what one was. There were standards for taking agency action, and that it would meet and exceed the arbitrary and capricious standard under the APA. And I think what the Supreme Court's decisions in Wilbur Bright and what we expect we'll continue to see in cases going forward, kind of elaborating on this sea change, is that the APA is still here, and there is still room for agencies to kind of have expertise and make decisions. It's just going to be a lot more court involvement in deciding, when a court will decide for itself when the court's judgment should be applied and substituted in for that of an agency, versus an arbitrary and capricious standard. So I think seeing how that all plays out will be showing up in the briefs.
You know, um, I guess I would say that in my experience with particularly with the banking regulators, that there was always a certain amount of humility, regulatory humility, that they wouldn't go and try and really stretch a law, even though you had this Chevron deference standard in place, that it was rare that you would sort of see an agency kind of use that to sort of create things out of whole cloth. I think the CFPB was very different in that regard. And I think that's why, in part, we see the backlash that we've had. Um, I want to move on a little bit. We've had a lot of news about mortgage fraud recently, uh, for interesting reasons that have nothing to do, I think, with what we would normally expect to see in the mortgage business. I'm curious what you guys think. I mean, obviously, um, we've got specific issues questions about, did somebody report a loan as being primary when it was really an investment property or really a second home. I don't really want to get into the facts of any particular situation, but what I'd like to talk about is how this all relates to um, this issue of the Federal Reserve independence and um, and sort of where you see that whole discussion going over the next few weeks and months.
Yeah. No, I mean, I guess from my perspective, it's there's the everybody from even the outset of this administration has been taking a pretty cautious approach with respect to the monetary policy authority of the Fed. Um, and we see it even in the early executive orders, like at the very beginning of the Trump administration. Um, there was an executive order that, every agency has to go through and, whatever it was. And then there'd be like a thing saying, except that the Fed, you get something different, with respect to your, monetary policy functions, you're carved out. And so there were executive orders. So there's an executive order that very like super consciously carved out the monetary policy function. Although that's the function of the Fed that the White House cares about a lot. And, I think President Trump is talking about how he wants 0% interest rates or whatever interest rates, low interest rates. He talks about it if not every day, he talks about it a lot. He talks about it when he's on a hot mic. He's talking about it. That's like a major goal of his. But his executive orders, which were not kind of shrinking violets in terms of taking on, things that he wanted to take on, didn't take on that issue. And then you had in the putative firing of the Federal Reserve governor. They didn't do it on the basis of I'm the president and I can just fire a Fed governor. He did it on the basis consistent, kind of potentially consistent. I'm not taking any positions on any litigations here, but he did it in the legal rubric of the actual statute, which was as if it's as a for cause termination of a Fed governor, which is what the statute, the existing statute calls for. And the questions are around, did the governor have due process? The questions around whether for cause, what does for cause actually mean? And there's, those are the kinds of legal issues surrounding the case. And then the governor brought her case saying, well, this is something, this isn't really about terminating me. This is about, the independence of the Fed. It kind of brought it back right around. It's as if she was channeling Brian Levy when she filed her lawsuit. And she said, this is what Brian is interested in. So this is what I'm going to talk about. And and I can't remember the name of the case. There was another one of these cases in which the president had fired a member of one of these bipartisan, multi-member agencies. I think it was the NLRB one, but I can't remember which one it was. And the Chief Justice Roberts' opinion, kind of carves out this thing saying, well, we're not talking about the Fed here with the history of the first Bank of the United States and the second Bank of the United States and, and so forth. And so there's certainly some recognition at the Supreme Court level that this is and he called the Fed a quasi-governmental or quasi-private, kind of institution. And there's clearly recognition both in the executive branch currently and in the judiciary that the Fed's kind of its own separate piece of things. And it's interesting when you look at like the first Bank of the United States, which, and these early 1800s cases that the founders of our country were arguing over whether we needed an independent central bank, right? Even at the very, very beginning. And I think particularly with, judges who view themselves as being originalists, right? And what was the original understanding of the Constitution when it was adopted? When you're an originalist and you have, the precedents go back to the late 1700s and the early 1800s of different pieces, that makes it like, the founders kind of thought that this was okay. So it's a little harder in those situations. And that similarly, right, in the funding case, in the CFPB funding case, um, you know, what goes back to the beginning of the Republic? The Customs House, which used to be where all the money came from, and all of the money in the federal government was from, interestingly enough, tariffs, and the Post Office. Both existed all the way back into the 1700s in our country, and it was kind of like, well, are those not okay? Right? If those are, how could those not be? How could those be constitutional if, unconstitutional if they go back to that period? So I think that the ancient history of some of this is actually a really important part of what will end up being in the briefing.
Yeah, I completely agree. Wrote my last musing about this topic. I think there's really 2 points. One is you're right. I think even the executive branch, even this unitary executive branch, there's some recognition that they needed cause to fire an official on the Fed. This whole idea that, Trump's going around saying I can fire Jerome Powell if I want, is not quite as simple. Um, and I think that's sort of one point. The other was like, I don't even think it's like, I think it's 9-0 at the Supreme Court that that the Fed is different, and we're not gonna like the Alito dissent in the funding case said basically there was a footnote that said the Fed is different. It's sanctioned by history. Well, like as I've said, sanctioned by history would be a great name for a moot court team, but it is not anything that an originalist, would actually a textualist would be able to support. But sanctioned by history in this case, it's precedent. They're like we're saying the Fed is unique, and now maybe there's some of the governance, the regulatory functions, the enforcement functions that the Fed has that maybe you could say are more executive, but the central banking function, that's doesn't belong in any other three branches. So anyway,
And it's also, I think you've given me sanctioned by history would be a great name for a legal thriller if I start writing them. Don't you think sanctioned by history would kind of work?
yeah,
Uh,
no, like I said, it's a moot
100%.
court team. It's like a flag football team in law school or something. All right. Let's move on. I want to get to fair lending because I know Caroline has some great insights about this immigrant case. And maybe I'll just let you talk, Caroline, because really want to hear from you on that and what's going on with
Yeah.
fair lending. Because a lot of people think, hey, fair lending, it's done. We don't have to worry about it anymore. Is that true?
Yes, we hear that from concerned legal departments and compliance teams all the time. Hey, we're hearing from our executive leadership, or we're hearing from ops, or we're hearing from so and so that we don't necessarily need to be doing reviews as often, or do we need to do reviews as often? Do we need to do disparate impact reviews at all? Right? Is that actually a bad form now to do a disparate impact review? And the answer is, first of all, the statute of limitations on the Equal Credit Opportunity Act, ECOA, is 5 years, which is longer than a single term of any federal administration. So if there's administration change, I think everyone can expect that what is policy today may not be policy tomorrow, and there is a look back opportunity for any future administration. And I'm sure y'all have heard that, from other lawyers and from folks on your own teams over the past couple of months as you kind of think about how to move forward in this new era. But it definitely is a new era. And I think the executive orders really set the stage in the spring for how things are going to be really different, just at an enterprise level across the federal government. We had, from day one, executive orders targeting DEI initiatives, but in April, we got the executive order expressly saying disparate impact enforcement is going to go away at the federal level and stating that agencies, will be required to move forward with policies that implement that policy goal. And we've really seen that come to pass over the summer. We've got the OCC announcing that its examiners are no longer going to be examining for disparate impact exam manual guidance for the FDIC removed late last month. And so, it does seem that at least from a supervisory standpoint, and, very likely also almost certainly an enforcement standpoint at the federal level, disparate impact and, these cases built on statistical analysis are going to go away for a while. That doesn't mean that they will end across the country. It doesn't mean we won't hear about them in courts. It just means that we're unlikely to see them at the federal level, and that, in fact, we're seeing efforts by the Department of Justice and the CFPB to try to undo existing settlement agreements that they had reached, not just on disparate impact, but a redlining case against ESA Bank, and then you had the Townstone attempt to reverse the stipulated judgment with the $105,000 penalty the CFPB tried to undo. And what you're seeing is this administration saying, hey, we don't agree with some of these actions, these agreements that were entered into during the Biden administration. So we're going to go to the courts and we're going to say, hey, can we either terminate the agreement or vacate the agreement or just basically try to undo it going forward? And judges are resisting that. In the Townstone case, we saw, a joint motion to vacate the stipulated judgment for the civil money penalty against Townstone. And the CFPB said, we'd like to vacate this. And the court said, no, there has to be an end to litigation at some point. And for that reason, there's a very high barrier to vacating settlement agreements. And you haven't shown that you've satisfied, that threshold requirement to be able to move forward with that. I think that the phrasing used there was extraordinary circumstances, and it just wasn't satisfied. So we've seen all of that. And then we have, on the flip side, private plaintiff action and states. And on the private plaintiff side, the immigrant action is a really interesting lawsuit. We had an appeal, a decision from the Second Circuit in the past, month on a case that was originally brought in, I think, around 2011, claiming that there was a no income, no asset loan program that was reverse redlining, and meaning that there would be an unfair or predatory targeting of applicants or borrowers based on their race that is either disparate impact, disproportionately likely to impact them based on their race, or disparate treatment, intentional, different offerings offered to those groups that are unfavorable for them. And the facts that were laid out before the jury that initially decided this case at the lower court level in 2016 showed that allegedly, 75% of the advertising budget went to 4 newspapers that either had an exclusively African American or Hispanic readership. And then there were statistics showing that these particular loans were more likely by 32% to end up in majority African American neighborhoods versus similarly situated majority white neighborhoods. So a very traditional looking disparate impact case showing, marketing plans, redlining case showing marketing plans combined with statistical analysis showing differential outcomes within geographies to really show, alleged reverse redlining targeting these geographies on the basis of race. And the Second Circuit found that, it basically it upheld this jury decision saying that yes, redlining can exist here, even though the challenge from the defendant was that the court had not upheld a robust causality requirement that had actually been implemented, as many of you will recall, in the Inclusive Communities case, a while back in the Supreme Court, saying that if you're going to move forward with theories based on statistical analysis for facially neutral policies, there needs to be a robust causality between those policies and the outcomes in order to move forward. There was also a really interesting, and I know, Jeff, you'll have a lot to say about this because we've talked about it, and I know you have, thoughts about what the impact could be if the Supreme Court doesn't take up this challenge and give us a decision about equitable tolling of the statute of limitations for the Fair Housing Act in this case. Essentially, the setup for this thought experiment coming out of the immigrant matter is if there is a situation where a plaintiff theoretically can't understand that there was a broader policy of reverse redlining until they understand that there is a group of potential plaintiffs, is the statute of limitations told until that realization is possible? And the Second Circuit says, yes, we have to look at fairness as part of an assessment of whether a statute of limitations is equitably told. And the dissent said, hey, that's never been part of understanding when equitable tolling should be applied, despite the name equitable tolling. It's really always been a standard of, when it's really necessary that there's a high standard for applying equitable tolling of a statute of limitations. And
I
so
thought there was some requirement of showing that there was like concealment, that you have to, like, if somebody concealed something that then you can argue equitable tolling. But
so the Second Circuit would actually did find that there had been an element of concealment. So and they didn't actually necessarily incorporate that into fairness explicitly, but that was one of the things that they highlighted about the facts here and the underlying decision is that there was evidence that the lender did conceal that this was a plan to target majority minority neighborhoods. So
how
I
is
think
that how is
They could
how
put
is
it on
that
the marketing.
concealment if you how are you
Like,
concealing
this is
your
an
marketing?
effort to get you to get this loan. And then, it's like, so
Yeah.
how can you both attack them for marketing it in the minority neighborhood and say that it was concealed? That's, I don't know. Well, the Second Circuit decision made my head explode. And on this among other things, on the equitable tolling issue. But I remember, I don't know, a long time ago, a client said, so how far back is my liability? I was in a defending a fair lending action, and it was a government action. And you looked at the law and it's like, well, and we kind of have a more clear statute of limitations in ECOA, but on the Fair Housing Act, it was kind of like, well, the case law is, there's equitable tolling, and the only standard was, well, we kind of trust the government enforcement officials to be fair about how far back they'll go. And as a defense lawyer, I lost my confidence that the government enforcement officials will always be fair some decades ago. So,
Jeff,
I always thought this was a problematic issue.
one of the things that I remember from the inclusive communities opinion, in Justice Kennedy's opinion in that case, 5-4, right? There was a very close decision by the Supreme Court, which established this robust causality requirement. And he basically said, we sort of trust that the government is going to use this disparate impact analysis judiciously in a way, just exactly as you're saying, that they're going to show some regulatory humility. I mean, they're going to use it only when they really have to, instead of is this, the way that it turned out that, it was being used in a lot of the redlining cases during the Biden administration. So I'm wondering, Caroline, I'd love your
Don't
opinion on
tell me
this.
are you always also having a crisis of faith?
No, I don't. I've always had a crisis of faith. I mean, that's just who I am. But I'm curious about whether you think if the sort of that issue was teed up for not the equitable tolling issue, but the disparate impact question, is it evidence of discrimination? If that issue was sort of squarely teed up at the Supreme Court today, if you think that would still be the law of the land.
So it is going to be teed up. At least it's part of the cert petition. So, I mean, the question that I have is even broader than that. And then I'll get to your specific question. But earlier when I was talking about the case, I kept tripping up between disparate impact and redlining. And that's not because I couldn't get my words straight. It's because this case is the latest example of how redlining, which historically I think we've all thought of as a disparate treatment type claim, an intentional discrimination, a choice to go in or to avoid these areas with particular products, is actually now fully conflated with elements of disparate impact theory, like robust causality and, from the inclusive communities case, which was examining disparate impact. And so we have on full display now that, I think there's no hiding it anymore. You can't just bucket redlining into disparate treatment any longer. The statistics that are being used to prove redlining are very similar to the statistics, the way that those statistics are being used to proving disparate impact cases. Taking a position from a lender that like, hey, we do not have a policy of discrimination, either on an actual protected class or on a proxy therefore, right? We are not discriminating. We are just offering a product with these credit criteria, and these are most attractive to these areas, and that's who the applicants are most interested in the product. And it ends up being higher rate, appears to plaintiffs, to consumer advocates, possibly regulators as a predatory product, and boom, you have a reverse redlining allegation. And you're now squarely in the middle of what is the redlining precedent that we've looked at for a long time, saying that this is a choice and trying to prove that there wasn't intent in these marketing and application and origination policies, with do we even care if there was intent anymore when it comes to proving out a redlining case? Because now we're talking about inclusive communities, and do we need a robust causality requirement? Going to your specific question about will that still be the law of the land, I don't think it's ever been clear, or at least it's never been not debated, as to whether the robust causality requirement was law of the land. I would argue yes. I think that it was pretty clear that this was a new element that basically heightened a bit the test by the Supreme Court for assessing whether there would be disparate impact in the instance of a facially neutral policy. But the way that opinion is written, you can see how, and you can actually see the arguments being made in these filings in the immigrant case, that some courts and obviously advocates are going to say, well, that's just a restatement of an existing principle, right? That's something that already needed to be there. You had to show a link between the neutral policy and the outcome in the statistics, and they're just kind of describing that. And so I think it will be squarely, before the court, or at least, that's the aim. And I expect that at a minimum, we will end up with the language being affirmed as, yes, that's what the Supreme Court said, and there's nothing wrong with that. The question really is not, is the language still going to be there? It's, is that a separate part of the test? And that's what we're still unclear on, I think.
That's great. Thank you. Marty, you haven't had a chance to speak yet. We only have a couple minutes here. Do you have any questions for our guests that you are dying to ask?
Well, it's been a great discussion first. Thanks. I apologize. I had some technical difficulties getting on. But Caroline, I'm curious as to whether or not you think that the Supreme or how long would it take a new administration, when you were mentioning that the statute of limitations earlier, how long would it take them to come in and do analysis to even bring a claim, assuming that you see the changeover that we're kind of anticipating with this administration, just assuming you had a similar one next time? It seems to me you still have some dead time before they'd be ready to even commence these kind of actions as well. So I was just curious what your thoughts were on that.
Yeah, I will give my thoughts. I'll be curious to hear what Jeff thinks as well. My thought is that they would want to move, if there were a change to, a Democrat administration, I think they would want to move very quickly. And unfortunately, mortgage is the place they can do that because of the HMDA data, right? They don't have to wait for a supervisory exam or some kind of, investigative demand or subpoena to get the information they need to be able to prove out what is now forming up to be the disparate impact redlining analysis that they would want to do in certain geographies for, whichever lenders they, felt really abandoned, marketing in key areas, or perhaps looking back at consent orders that had identified prior violations and making sure that institutions were keeping up with the obligations they signed on to in settlements. So I think they could actually move pretty quickly. These statistical analyses don't take much time. Historically, what they have liked to do is also have evidence of intentional discrimination to pair with the statistics. That does take more time to get, but they would be up against the clock if they wanted to reach back all 5 years. The thing is, they would only need to reach back a couple of years, which would give them more time to go back into the Trump era. Jeff, do you have any thoughts?
Yeah, I mean, I've kind of two thoughts. One, similar to how some kind of private think tanks and others were getting ready during the entire Biden administration in case there would be another Republican administration starting in 2025. I think you can easily assume that the kind of, progressive and liberal think tanks are all getting ready for, my shorthand for it is President AOC, without making any suggestions as to who would be the Democratic nominee in the next election. But so I think you're going to have a lot of, in essence, NGOs preparing for that potential eventuality, and they'll be ready with, they'll hand over a thumb drive or whatever, like, here are our 10 favorite targets, kind of thing. A second aspect of it to me is, most of these cases historically have come in from the supervisory, the bank supervisory mechanism, and that's going to take a while to get back on its feet. So that'll be a couple of years. And the third thing is, we know from the beginning of the CFPB, when the CFPB first came into being, they brought a number of fair lending cases, and we were the defense counsel in some of them. And the CFPB was seeking to go back, at least at the outset, from 2012, 2013, when these, things were being investigated. They were asking for data going back into the late 1990s. So they were asking for like 15 years of data, not 5. And then we were like, well, like, look at the statute of limitations. And they were like, equitable tolling, which is why I hate that so much. Right. So, but anyhow, so I wouldn't assume that they will be modest and judicious in how they, if there is a change of administration, in how enforcement officials, because then we see it, you see it in enforcement people, regardless of what party, they tend to be pretty aggressive in going after the goals that they're going after. And I would expect that to be the case, in that eventuality.
Well, thanks, Jeff. Marty, I look like you've got more to ask, but I sort of have to cut things off here because we're out of time. Yeah. I really, really want to thank our guests again. Jeff, by the way, I ran into Jeff last year in Turks and Caicos on vacation with my wife. All of a sudden I look up and that guy looks exactly like Jeff Naimon. And it, got to see Jeff in a bathing suit, which is really exciting. Let me just tell you. So, anyway, where are we going this year, Jeff? Just wondering.
Will you be joining my family in New Zealand? Do you want to come?
Yeah, absolutely. I will stalk you there. All right, guys. Thank you again. Thanks to our sponsors, Polunsky Beitel Green. Thank you to Orrick for allowing us to have their partners, Jeff Naimon and Carolyn Stapleton. Thank you very much, and we'll catch you all next month.
Thanks, everyone.
Thanks, guys.
Bye-bye.